Representation. A representation is a statement an applicant makes, believed true to the best of their knowledge, that the insurer relies on to underwrite a policy. If a representation proves false and material, the insurer may have grounds to void coverage. Misrepresentation. A misrepresentation is a false statement made on an application. Because insurance depends on accurate information, a material misrepresentation can let the insurer rescind the policy or deny a related claim. Material misrepresentation. A material misrepresentation is a false statement significant enough that the insurer would have charged more, changed terms, or declined coverage had it known the truth. This is the threshold that allows an insurer to legally void a policy. Concealment. Concealment is the intentional failure to disclose a known material fact during underwriting. Insurance requires utmost good faith, so concealment can void the contract just as an active false statement can. Rescission. Rescission is the act of unwinding a policy back to its start, treating it as if it never existed, usually for material misrepresentation, concealment, or fraud. Rescission is the insurer's primary remedy when an applicant wasn't truthful. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. Reformation. Reformation is a legal remedy where a court rewrites a written policy to correct a mutual mistake or clerical error. It changes the wording so the contract accurately reflects the parties' true intent. Void. A void contract is one that is invalid and unenforceable from the very beginning, as if it never legally existed. A contract for an illegal purpose or with no insurable interest is void, rather than merely cancelable. Voidable contract. A voidable contract is valid but can be cancelled or enforced by one party because of a defect such as fraud or misrepresentation. A policy obtained through a lie is voidable at the insurer's option. Unilateral contract. A unilateral contract is one in which only one party makes a legally enforceable promise. Insurance is unilateral because only the insurer promises to pay. The insured makes no enforceable promises once the premium is paid. Conditional contract. A conditional contract requires certain conditions to be met before either party must perform. Insurance is conditional because the insurer pays only if the insured has met duties like paying premium and filing proof of loss. Offer. An offer is the proposal starting contract formation. It is typically made when an applicant submits a completed application along with the initial premium, inviting the insurer to accept the risk. Acceptance. Acceptance is the insurer's agreement to the terms of an offer, often signaled by policy issuance or underwriting approval. Combined with consideration, acceptance creates a binding contract. Lawful purpose. Lawful purpose is the requirement that a contract's objective be legal. A policy must serve a lawful purpose to be enforceable, which is why insuring illegal activity or property produces no valid contract. Competent parties. Competent parties means everyone entering the contract has the legal capacity to do so. Minors, the mentally incompetent, and the intoxicated may lack competence, which can make a resulting policy unenforceable. Parol evidence rule. The parol evidence rule prevents prior oral or written statements from contradicting the final written policy. It protects the integrity of the policy as the complete and controlling agreement between the parties. Contra proferentem. Contra proferentem is the rule that ambiguous policy language is interpreted against the insurer that drafted it. Because the insured had no say in the wording, courts resolve unclear terms in the insured's favor. Principal. The principal is the insurer that a producer represents in an agency relationship. Acts a producer performs within their authority legally bind the principal, making the insurer responsible for the producer's conduct. Agency. Agency is the legal relationship in which a producer acts on behalf of an insurer. Through agency, the knowledge and actions of the producer are generally attributed to the insurer they represent. Producer. A producer is a licensed person or entity that sells, solicits, or negotiates insurance. The term covers agents and brokers alike and identifies who is authorized to transact insurance with the public. Express authority. Express authority is the power explicitly granted to a producer in writing, usually in the agency contract. It defines exactly what a producer is authorized to do, such as bind coverage or collect premium. Implied authority. Implied authority is power not written down but reasonably necessary to carry out a producer's express duties. It lets producers handle routine actions the insurer never spelled out but clearly intended. Apparent authority. Apparent authority is authority the public reasonably believes a producer has because of actions, signs, or materials provided by the insurer. The insurer is bound by actions within this perceived power. Fiduciary duty. A fiduciary duty is the obligation to handle others' money and interests with the highest trust and good faith. Producers owe a fiduciary duty when holding premiums, which must be kept separate from personal funds. Appointment. An appointment is the insurer's formal authorization for a producer to represent and sell on its behalf. A producer generally must hold both a license and an appointment to transact business for that insurer. Errors and omissions. Errors and omissions, or E&O, is professional liability coverage protecting producers from claims of negligent advice or service. E&O guards against losses when a mistake or oversight harms a client. Continuing education. Continuing education, or CE, is the ongoing coursework producers must complete to keep a license active. Continuing education requirements ensure producers stay current on laws, products, and ethical standards. Solicitor. A solicitor is a licensed individual authorized to solicit insurance business on behalf of a licensed agent or broker. A solicitor generally cannot bind coverage or issue policies independently. Field underwriting. Field underwriting is the producer's role in screening applicants and gathering accurate information at the point of sale. Good field underwriting helps the insurer's underwriters make sound, well-informed decisions. Commingling. Commingling is improperly mixing client or premium funds with a producer's personal or business money. Commingling violates a producer's fiduciary duty and is a common cause of license discipline. Rebating. Rebating is offering a client something of value not stated in the policy to induce a purchase. Rebating is generally illegal because it gives unfair inducements and can distort honest competition. Defamation. Defamation is making false, malicious statements about a person's or insurer's reputation or financial condition. As an unfair trade practice, defamation is prohibited because it can unjustly damage competitors. Coercion. Coercion is using physical or economic force to compel someone into an insurance transaction. Coercion is an unfair trade practice because it removes the free choice that fair dealing requires. Boycott. A boycott is refusing to deal with someone unless they agree to certain terms. As an unfair trade practice, a boycott illegally pressures parties and interferes with normal competition in the market. Redlining. Redlining is unfairly denying or pricing coverage based on the geographic area of a risk rather than its true merits. Redlining is prohibited because it amounts to unfair discrimination against entire neighborhoods. Disclosure. Disclosure is the required sharing of material information with applicants and insureds. Proper disclosure ensures consumers understand coverage, costs, and rights before and during the life of a policy. Conflict of interest. A conflict of interest exists when a producer's personal interest could improperly influence their professional duty. Recognizing a conflict of interest protects clients and preserves trust in the transaction. Domestic insurer. A domestic insurer is one operating in the same state where it is incorporated. The label matters for regulation, since an insurer is domestic in its home state and treated differently elsewhere. Foreign insurer. A foreign insurer is one incorporated in another U.S. state from the one where it does business. A foreign insurer must be licensed in each additional state where it wishes to operate. Alien insurer. An alien insurer is one incorporated outside the United States. An alien insurer must meet specific licensing requirements to transact business within any U.S. state. Stock insurer. A stock insurer is owned by shareholders and operated for their profit. It may pay taxable dividends to stockholders, and policyholders generally have no ownership rights in the company. Mutual insurer. A mutual insurer is owned by its policyholders rather than outside shareholders. It may return non-taxable dividends to those policyholders who effectively share in the company's results. Reciprocal exchange. A reciprocal exchange is an unincorporated group whose members insure one another, managed by an attorney-in-fact. Each member of a reciprocal both provides and receives coverage within the pool. Certificate of authority. A certificate of authority is the state license allowing an insurer to transact business. An insurer cannot legally sell coverage in a state without holding a valid certificate of authority there. NAIC. The NAIC, or National Association of Insurance Commissioners, develops model laws and coordinates regulation among the states. It promotes uniform standards even though insurance is regulated state by state. Insurance Commissioner. The Insurance Commissioner is the state official who enforces insurance laws and oversees the industry. The Commissioner licenses insurers and producers and protects consumers from unfair practices. Department of Insurance. The Department of Insurance is the state agency that regulates insurers and producers. It handles licensing, examinations, and consumer complaints to keep the market fair and financially sound. Solvency. Solvency is an insurer's ability to meet its financial obligations and pay claims. Maintaining solvency is central to regulation because insurers must remain able to keep the promises they sell. Insolvency. Insolvency is an insurer's inability to pay its debts and claims as they come due. Insolvency triggers regulatory intervention and may bring in a guarantee association to protect policyholders. Market conduct examination. A market conduct examination is a regulator's review of an insurer's sales, underwriting, and claims practices. It checks how fairly an insurer treats consumers rather than just its finances. Financial examination. A financial examination is a regulator's audit of an insurer's financial condition and records. It verifies that reserves, assets, and reporting are accurate so the insurer can stay solvent. Risk-based capital. Risk-based capital, or RBC, is the minimum capital an insurer must hold based on its size and risk profile. Risk-based capital standards help regulators spot weakly capitalized insurers before they fail. Statutory accounting principles. Statutory accounting principles, or SAP, are the conservative accounting rules insurers use for regulatory reporting. They emphasize solvency and the ability to pay claims over showing profit. Annual statement. The annual statement is the detailed financial report insurers file with regulators each year. It gives regulators a standardized view of an insurer's finances to monitor ongoing solvency. Admitted assets. Admitted assets are the assets regulators allow an insurer to count toward meeting its financial requirements. Limiting recognition to admitted assets keeps solvency measurements conservative and reliable. Policyholder surplus. Policyholder surplus is an insurer's assets minus its liabilities, serving as a financial cushion. A strong policyholder surplus shows the insurer can absorb unexpected losses and still pay claims. Reserves. Reserves are funds an insurer sets aside to pay future and outstanding obligations. Accurate reserves are essential to solvency because they ensure money is available when claims must be paid. Cease and desist order. A cease and desist order is a regulatory directive to stop a prohibited practice immediately. Regulators use a cease and desist order to halt unfair or unlawful conduct while a matter is resolved. License revocation. License revocation is the permanent removal of a producer's or insurer's authority to do business. Revocation is among the most serious penalties a regulator can impose for misconduct. Gramm-Leach-Bliley Act. The Gramm-Leach-Bliley Act is a federal law requiring protection and disclosure of consumers' non-public personal financial information. It obligates insurers to safeguard client data and explain privacy practices. Fair Credit Reporting Act. The Fair Credit Reporting Act, or FCRA, governs how consumer report information is used in underwriting. It gives applicants rights when their credit or history affects an insurance decision. Consumer report. A consumer report is information gathered on an applicant, such as credit or history, used in underwriting. Insurers must follow the Fair Credit Reporting Act when relying on a consumer report to make decisions. Pure risk. Pure risk is a situation offering only the chance of loss or no loss, with no opportunity for gain. Pure risk is insurable, which is why insurance covers events like fire, death, or accidents. Speculative risk. Speculative risk involves a chance of loss, no loss, or gain, such as gambling or investing. Speculative risk is not insurable because the possibility of profit removes it from insurance's purpose. Risk avoidance. Risk avoidance is eliminating an exposure entirely by not engaging in the risky activity. As a risk management technique, avoidance removes the chance of loss, but may also forego a benefit. Loss control. Loss control is any activity that reduces the frequency or severity of losses, like sprinklers or safety training. Loss control lowers risk and can reduce premiums by making claims less likely or smaller. Risk retention. Risk retention is keeping or assuming a risk rather than transferring it, often through a deductible or self-insurance. Retention makes sense for losses small or predictable enough to absorb directly. Risk transfer. Risk transfer is shifting the financial burden of a risk to another party, which is the basic function of insurance. Through transfer, an insured pays a premium, so the insurer bears potential losses. Risk sharing. Risk sharing is spreading risk among a group, so no single member bears a full loss alone. Insurance works through risk sharing, pooling many premiums to pay the losses of the unfortunate few. Law of large numbers. The law of large numbers holds that the more similar exposures an insurer pools, the more accurately it can predict losses. This principle lets insurers set reliable rates for large groups. Homogeneous exposure units. Homogeneous exposure units are large numbers of similar risks needed to predict losses accurately. Grouping homogeneous units lets the law of large numbers work and supports fair, stable pricing. Fortuitous loss. A fortuitous loss is one that is accidental and unexpected rather than intentional. Insurance covers fortuitous losses because intentional or certain losses defeat the purpose of pooling random risk. Diversification. Diversification is spreading exposures across different types or locations to avoid concentrated loss. Insurers use diversification so a single catastrophe cannot wipe out a large share of their book. Insurable risk. An insurable risk is one meeting conditions like being definite, measurable, fortuitous, and not catastrophic. These traits make an insurable risk something an insurer can price and cover responsibly. Frequency. Frequency refers to how often losses occur within a group of exposures. Insurers analyze frequency alongside severity to estimate expected losses and set premiums that match the true risk. Severity. Severity refers to the size or cost of losses when they happen. Insurers weigh severity with frequency, since a rare but severe loss can matter as much as many small, frequent ones. Rate. A rate is the price charged per unit of exposure. It serves as the basic building block of insurance pricing, which is multiplied by the number of exposure units to calculate the final premium. Pure premium. Pure premium is the portion of the rate covering expected losses, before adding expenses and profit. It is the loss-based foundation on which the full premium is built. Expense ratio. The expense ratio is an insurer's operating expenses expressed as a percentage of premium. Together with the loss ratio, The expense ratio shows how efficiently an insurer turns premium into coverage. Manual rating. Manual rating, also called class rating, charges every member of a similar group the same base rate from a rate manual. It is efficient for large numbers of comparable risks that share similar loss characteristics. Schedule rating. Schedule rating adjusts a base rate up or down for an individual risk's specific features. It rewards favorable characteristics and surcharges hazards, tailoring price to the particular exposure. Merit rating. Merit rating adjusts premium based on an insured's actual loss experience. By tying price to real results, merit rating rewards those with few claims and charges more to those with many. Standard risk. A standard risk is an applicant who qualifies for coverage at normal rates and terms. Standard risks represent the typical exposure an insurer expects and prices its base rates around. Substandard risk. A substandard risk is a higher-than-average exposure that is charged more or given limited terms. Classifying substandard risks lets insurers still offer coverage while pricing for the added danger. Preferred risk. A preferred risk is a lower-than-average exposure that qualifies for reduced rates. Identifying preferred risks lets insurers reward safer applicants and compete for the most desirable business. Declination. A declination is an insurer's decision not to offer coverage to an applicant. Declination happens when a risk falls outside underwriting guidelines or is too hazardous to insure profitably. Rate filing. A rate filing is the submission of proposed rates to the regulator for approval or to be kept on file. Rate filings let regulators confirm rates are fair before or shortly after they take effect. Rate adequacy. Rate adequacy is the principle that insurance rates must be high enough to pay all losses and expenses while maintaining solvency. Rates must be adequate, but not excessive or unfairly discriminatory. Application. An application is the form providing the information an insurer uses to underwrite and issue a policy. The application becomes part of the contract, so its accuracy directly affects coverage. Ceding company. A ceding company is the primary insurer that transfers part of its risk to a reinsurer. By ceding risk, the company protects itself from large losses and can write more business safely. Reinsurer. A reinsurer is the company that assumes risk passed to it by a primary insurer. The reinsurer helps spread large or concentrated risks, strengthening the stability of the whole system. Facultative reinsurance. Facultative reinsurance is reinsurance negotiated individually, one risk at a time. It lets a reinsurer evaluate and accept or decline each specific risk, useful for unusual or very large exposures. Treaty reinsurance. Treaty reinsurance is an automatic agreement covering an entire class or book of business. Under a treaty, the reinsurer accepts all qualifying risks without reviewing each one individually. Cession. A cession is the portion of risk a primary insurer passes along to a reinsurer. The cession defines exactly how much exposure is being transferred under a reinsurance arrangement. Retrocession. A retrocession is reinsurance that a reinsurer itself buys to transfer some of its assumed risk. Retrocession spreads risk even further, protecting reinsurers from dangerous concentrations. Excess of loss reinsurance. Excess of loss reinsurance pays only for losses above a set retention amount. It protects the primary insurer from severe individual or aggregate losses while leaving smaller ones to the insurer. Pro rata reinsurance. Pro rata reinsurance has the insurer and reinsurer share premiums and losses by an agreed proportion. Both parties participate from the first dollar, splitting results according to that share. Bad faith. Bad faith is an insurer's unreasonable failure to honor its claim or policy obligations. Bad faith can expose an insurer to damages beyond the policy limit because it breaches the duty owed to insureds. Notice of loss. A notice of loss is the insured's required notification that a loss or claim has occurred. Prompt notice of loss is a policy condition that lets the insurer investigate and respond in time. Settlement. A settlement is the agreed resolution and payment of a claim. A fair and timely settlement fulfills the insurer's core promise and closes the matter for both the insurer and the claimant. Arbitration. Arbitration is submitting a dispute to a neutral third party whose decision resolves it. Arbitration offers a faster, less costly alternative to lawsuits for settling many insurance disagreements.